Hello, this is Rex Crandell, and today we're going to cover Schedule C, which is part of a individual tax return, IRS Form 1040, and it's the schedule that reports business income and deductions for tax purposes. Class overview, what we're going to be covering is what is a Schedule C that is attached to the 1040, who must use the form, what kind of stuff do you have to put on the Schedule C? What is taxable income and what is not? What can you deduct to make your tax bill as small as possible? It's the free enterprise system in action with you being the boss. We'll cover types of expenses, including vehicle cost, depreciation, business operating expenses, home office, allocation of business and personal expenses. How to keep out of trouble with the Internal Revenue and the California Franchise Tax Board will be discussed. Before you start preparing the Schedule C, a prerequisite is you need to have your accounting system up to date and posted for the year if you use QuickBooks or some other software. If it's still in the receipts unorganized state for your bookkeeping, there's no way you can start the tax preparation. And you should keep your bookkeeping up every month when you reconcile your bank statements. And besides, accounting is fun anyway, isn't it? Right. This is the Schedule C. It's got a lot of pieces. There's 48 lines total on two sides. We're going to be covering what's needed in the lines and the quality of the data in detail, and I'll give you suggestions along the way. So there's two sides to it, front and the back. The front has information identifying the business, then income, then we have expenses by categories, tentative net income, and then home office deduction before we get to the net profit or loss. The second side has a section for cost of goods sold for product-oriented businesses, a little bit of information about vehicle expenses, and then a section on page 2 for other types of business expenses. Self-employment comes with many perks, but when it comes to tax time, it means you'll be filling out more than just the 1040. Chances are you'll also need to file a Schedule C. The Schedule C form might seem daunting at first, but while it has several lines, 48 in total, you probably will not need every line, and most of the information required is straightforward. What is a Schedule C? You might be thinking that a Schedule C taxes, but the full name is profit or loss from a business, sole proprietorships. It's one of those tax forms that does exactly what the name says. It calculates your business net profit or loss for tax purposes. It's an essential form when it comes to most small business income tax returns. Sole proprietors can use the form, and single member LLCs are limited liability companies. And what that means is the person's formed a limited liability company with the state, and there's only one, normally it'd be shareholder, but LLCs call their owners members. The sole proprietor and single member LLCs need to fill out a Schedule C every year. Once you fill out the form, you'll file it and attach it to your Form 1040. Who needs to file a Schedule C? There's a good reason why some people refer to Schedule C as the self-employment Schedule C. If you're self-employed as either a sole proprietor or single member LLC, you'll need to fill this out every year. The sole proprietorship, it could be you're operating a business in your name or a fictitious business name, but no corporate or LLC entity. If you're a sole proprietor, if you're the individual running the business, according to the U.S. Small Business Administration, this means your business is not a separate legal entity, and the sole proprietor, you'd be responsible for all the debts and obligations of your business, but you also receive all its profits. What about side gigs? Yes, sole proprietorships also cover side gigs. So if you have a side hustle on top of your regular employment, you'll need to file Schedule C. Single member LLCs. Sole proprietorships often operate their business as single member LLCs. The LLCs are a popular business structure for operating business and for ownership of real property because they provide limited liability protection for the business owners on the debts of the entity. Unless the LLC elects to be taxed as a corporation, the IRS views a single member LLC as a quote disregarded entity. This means that a single member LLC is not considered a separate entity from its owner for income tax purposes, so it does not file a separate federal income tax return like a multi-member LLC or a corporation or a partnership. California does require single member LLCs to file a separate tax return every year from its owners. It's filed on California FTB 568 along with the minimum annual fee of $800 each year. Only the IRS treats LLCs as disregarded entity that does not need to file a separate tax return from its owner. For California, you must file a separate tax return. So for California, the LLC is not a disregarded entity. If you have one owner, what they call it in tax is single member limited liability company, frequently abbreviated SMLLC. If you're married and your spouse are considered one, you and your spouse are considered one owner, and you can elect to be treated as a single member LLC. However, if a married couple does not elect to be a single member LLC, then they're required to file the IRS Form 565 as a separate tax return not included with your IRS 1040. The advantage of the separate tax return is that you will have a much lower probability of receiving an IRS audit. Not fun. The reason that separately filed LLCs and corporations have a lower percentage of audit is that the IRS is required to have a higher skilled employee that understands the business aspect of these entities before they will allow them to do audits. The California Franchise Tax Board requires the single member LLC to file a separate FTB Form 568, even though they are considered a disregarded entity for federal tax purposes. They are subject to the $800 annual tax plus an additional LLC fee when the gross sales of the entity exceed $250,000 for any tax year. What information is needed on the Schedule C? Get the name of the proprietor, namely you, your social security number, or your individual taxpayer identification number if you're a non-resident alien for tax purposes. You list your business and profession. What do you call that kind of service? The IRS uses this information to evaluate the reasonableness of your expense deductions. There's a code. I'll go back and forth to the Schedule C. There's a code for enter the kind of business that you have. And that code is it's a North American Industry Classification System. NAICS, and that business code is used by the federal statistical agencies in classifying businesses for purposes of collecting, analyzing, and publishing statistical data related to the U.S. business economy. You can find this search feature to get your number you put on the tax return by going to the North American Classification System at census.gov.naics or from the instruction booklet for Schedule C. Okay. So this is what we've been talking about. And then Social Security number for the owner, and then we'll get to the federal employer ID. So your business name, this could be like a fictitious business name or the name of your single member LLC. And I want to point out and have everybody realize a new law came into effect. There's a new law that every business entity that's been like an LLC, partnership, or corporation must file with the IRS division called the Financial Crimes Network before the end of the year so that they can use the ownership information to help stop money laundering and other type of illicit activities. And there's large penalties if this beneficial ownership information report is not filed. Okay, so if you have an employer identification number, you would list that on the top of the 1040. If you don't have one, you can apply for one with the IRS. It allows customers to fill out information that might be needed on an IRS form 1099. And like if you're independent contractor and someone's going to give you a 1099, I suggest you have a federal ID number so you can give that to the customer and get your 1099 in the name of your business and also under your employer ID number instead of your Social Security. Gives you a little bit of privacy there with your Social Security number. Then fill in the business address. It might or may later be used to calculate your business mileage because of commuting to the office is not considered a deductible expense. Cash basis of accounting. Well, there's two kinds of bases of accounting. So on line F, we're looking at the method of accounting. And the first one is the most common. Cash basis accounting is a method where the revenues expenses are recorded only when cash is actually received or paid. This means that the income recognized when the money comes in, expenses are recognized when the money goes out, regardless of when the underlying transactions took place. So if you billed a customer last year and then they paid that invoice this year under the cash basis of accounting, you report the income this year. So transactions are only recorded when cash is exchanged. The approach is straightforward and often used by small business and individuals. It provides a clear picture of cash flow. However, it might not accurately reflect the business financial position or performance over time, especially if there are significant receivables or payables. Most small businesses use the cash basis of accounting. Some people I hear that receiving payments in cash is not taxable. That's not true. And contrary to popular belief, not reporting your cash received income is considered tax fraud. I recommend that you be honest and truthful in all your financial reporting. And this is because honesty is the glue that holds our entire society together. The other choice that's listed on the Schedule C for accounting method is the accrual basis of accounting. It's a method where the revenues and expenses are recorded when they are earned or incurred, regardless of when the cash is actually received or paid. So revenues recognized when it's earned, even the payment's not yet received. So you send an invoice, now it's considered income. Expenses are recognized when they're incurred, even if they're not yet paid. So you get an expense in the mail or an email, and at that point you haven't paid it, but you still include it as an expense on your books. This method provides a more accurate picture of the financial health of the business because it includes all income and expenses related to the period being reported, not just where cash transactions occurred. Um, all public companies are accrual basis. If you buy stock, most all small businesses use the cash basis of accounting. Then we have the question, did you materially participate on line G? Yes or no? The material participation, where did we go here? I don't know. I'm lost. Okay, so you want accounting method, material participation. A material participation test, active participation is less stringent standard than material participation. You may be treated as actively participating if you make management decisions in a significant and bona fide sense. Management decisions that count as active participation, including approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. Then there's a more severe participation rule. That means you're working in the business. You materially participate in the trade or business activity for the tax year if you satisfy the following tests. You participated in the activity for more than 500 hours. Your participation was substantially all the participation of all individuals for the tax year, including the participation of individuals who did not own any interest in the business. Your participation activity for more than 100 hours during the year, and you participated as least as much as any other individual, including individuals who don't own any interest in the activity for the year. And based on all the facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis during the year. Well, this sounds like a bunch of mumbo jumbo, and it is. What it is to try to keep well-off individuals from starting a business. They have nothing they're doing with it. They're not, somebody else runs it and everything related to it, and then they try to take a loss. That's when the material participation rules come in. And if they do not materially participate and there's a loss, then their losses are likely suspended as passive activities and not deducted till future years when there is a profit in the enterprise. The next question on line H, did you start the business this year? If yes, the IRS will look for pre-opening expenses that should be put on the depreciation schedule and not taken as a direct expense this year under Internal Revenue Code section 195. These pre-opening expenses, what we're talking about is, say you're building out a dog grooming business and you've rented a commercial space and you're going to open it for business November 1, and you've been building out the space, buying signs, putting in plumbing, and then as of November 1st, you're going to open. So all the expenses incurred before November 1 are considered pre-opening expenses. We're not yet in business. You can deduct up to $5,000 of business startup costs paid before the business was open. The remaining costs of the startup can be deducted over a 15-year period. The downside of the pre-opening cost is you do not get a tax deduction now for the full amount that you paid for startup costs. Did you make any payments that would require an IRS Form 1099? If, as part of your business, for each person who you have paid at least $600 for the following during the year following for the year, you fill out and file an IRS Form 1099 NEC for the independent contractors. The NEC stands for non-employee compensation. Services performed by someone who is not your employee, including parts and materials. And also it would include payments to attorneys, law firms, or other legal service providers. Person, that means a human being received the money from your business that you paid more than $600 and they're not your employee. Then if you will, you have to issue an IRS Form 1099 NIC, give a copy to the IRS and a copy to the individual. If you have and pay corporations or multi-member LLCs more than $800 for the year, you do not need to file an IRS Form 1099 NEC for those types of separate legal entities. Then the next question is, did you or will you file an IRS Form 1099? So you answer under a penalty of intimidation, yes or no, I did file them or not. So let's go to the income, which is the top 7 lines, 1 through 7 on the Schedule C. So gross receipts, total income you got during the year. Then if you had refunds, allowances, that's a minus, shows. Then cost of goods sold is a computation if you're in a product business. Then we come up with a gross profit. And it says other income, including federal and state gasoline or fuel credit. I never see any of that. So my returns are line 5, gross profits, the same as gross income. Then, since we talked about the cost of goods sold, it ends up being on the back of the Schedule C. And the cost of goods sold, it is a method, whether you're treating your inventory at cost or you're treating it at the lower of cost or market if it's gone down in value. Then it wants to know if you changed your inventory methods, yes or no. And then we get into the inventory computation. It's just a little bit of math. You take the inventory at cost at the beginning of the year, plus your purchases at cost, plus any labor that went into like manufacturing and materials that maybe went into building a product. And then you subtract your ending inventory and you come up with the cost of goods sold. In accounting school is almost like a little jingle. You go, beginning inventory plus purchases less ending inventory is your cost of goods sold. Whoop-de-doo. Okay, so cost of goods sold means your expense in a business that has inventory that sells goods, not just a service business. And then at that point, after you've done the cost of goods sold, you list it on line 4, page 1 of the 1040. Now we're going to cover part 2, business expenses. Going back to the 1040, it's this middle section. A business expense is a payment that is directly related to the operation of the business, It's a payment that's ordinary and necessary for this particular business. Ordinary and necessary is a buzz phrase from the IRS. So is it ordinary and necessary or not? If you hire a babysitter so the parent of a young child can work, it may be necessary, but it's not considered directly related to the operation of the business. Therefore, it is not considered a business expense. Would the expense seem reasonably related to your business if an independent third party looked at the expense, a third person like an IRS auditor, and gave their opinion? If the payment included elements of business benefit and also included in the expense that was for the personal non-business benefit to the owner, then the expense will need to be split into business percentage before you can figure if it's deductible or not. If you want to know if an expense is deductible, we have what's called the straight face test, and that is, can you tell a third party about your expense without laughing? If not, then you do not have a business expense. Now, this is the center of the Schedule C. It shows expenses by categories that we will discuss. And you might want to design your accounting system to include these items so you have things to fill in from your bookkeeping system. And then if you have other categories of expense that is not listed in the standard wording, then you go to line 27A, which is a list on the page 2 of the 1040 Schedule C, and list those other expense items. So what we're going to do now is let our fingers do the walking through the Schedule C, going down the expenses on the one column and then office expenses in the other column starting. And let's get started. Advertising is self-explanatory, advertising a promotion. But then we get into car and truck expense, and that one can be a bucket of worms and a lot of bookkeeping and things. So you have two options when claiming auto and truck expense. There's two overall methods. One is called the standard mileage rate, and the other is called the actual operating expenses. The standard mileage rate, you get a cents per mile to deduct. The actual operating expenses, you make a chart of your vehicle expense, then you figure out what percentage you really use the vehicle for business, and then you only deduct the business component. So the standard mileage rate, you can only use this option if you own the vehicle, not leased, and you have always used the standard mileage rate when claiming the expenses for the vehicle. Or if you're leasing the vehicle for the entire time period you're leasing. For the amount of deduction, cents per mile for last year, 2023, you could write off 65.5 cents a mile. And for 2024, you can write off 67 cents per business mile. And with that method, you'd have to be able to prove you had some business miles and prove that you actually used the vehicle for the benefit of the business. The second method for vehicle expense is called the actual operating expense method. When using this option, you'll include the business portion of your vehicle expense, such as gas and insurance. If you choose this item, you'll need to fill out line 13 on the 1040, which talks about depreciation, and include any lease payments on line 20A from the Schedule C. No matter which option you choose, it's important that you have evidence to support these claims for vehicle use. such as gas receipts or repair receipts and some kind of record of the mileage that you drove. Okay, this is a worksheet that we use. It's not part of the government form. And it helps us determine what the proper business expense for the vehicle is. So we start out this auto expense worksheet describing the vehicle, when was it started using in the business, and the first line is the total business miles for the year. And that's relevant because that's what we're trying to deduct. And then it has the total miles driven during the year. And so we want to know the percentage of business to total. So the 13,000 over 28,000 ends up with 46% of every mile you drove, we have determined to be business related. Then what we do is take the total vehicle expenses for the year by categories, then apply the business use percentage that we just developed. So we're describing, the vehicle costs, gas, oils, repairs, maintenance, insurance, license, parking, everything to do with the vehicle. These might be good categories for your accounting system. Then we list the total cost, business and personal. Then we take the business use percentage and reduce the cost that you paid down to the business use percentage. And then we run a total of what was the business expense using this method. Okay, we come up with $5,688. So that's one of two choices. Now we want to look at the per mile optional method. And what we'll do here is determine another method, and then we're going to take the bigger deduction of the two methods. So what we do on the per mile optional method is we list the business miles, 13,000, times the business use percentage that we developed at the top of the form, and we came up with 85.15 for the business expense. Then we add items such as parking and tolls at 100%, interest expense. We take the total amount of interest times the business use percent. And on this method, we came up with a deduction of 10,000. So you deduct the higher of the actual costs of 56.88 or the standard miles at 10,000 deduction, and then you bring that line, the 10,000 business expense based on the mileage method, and you bring that back to line 9 on your Schedule C. That's the number you enter in for your auto expense. So this is a view of the entire form. So we did business use percent on the top, actual cost method in the middle. On the bottom, we did the standard mileage rate, and we compared that the actual cost of 5,600 was less than the mileage rate method at 10,265. Typically, you have to decide when you're getting a vehicle whether you're going to lease or buy the vehicle. We typically recommend making this decision based on what's best for your overall tax and financial picture rather than purely based on tax. But what do I mean overall financial picture? For example, if leasing a car usually requires less money out of pocket than buying a car, also monthly payments are significantly lower. Keeping your car cash on hand may be a higher or concern for you, so leasing may be better in your situation. However, let's keep in mind that leasing is merely renting a car. At the end of the lease term, you will not own anything. In today's world, a good car may last 10 years or more with proper maintenance. Buying a vehicle and then with it down the road, continuing to drive the vehicle with no payments may result in substantial savings in cash flow over the long term as compared to a lease, where at the end of the lease, you're now in a position of getting another car and a new car payment, which will continue to drag down your monthly income. There's a commercially available uh, internet calculator if you want to play around with the numbers of buy versus lease. You can find that at Edmunds, EDMUNDS.com, calculators, lease versus buy. It may be helpful to understand the buying and leasing for tax purposes. Here's the general principle to follow as far as the tax implication of buying or leasing. If you're looking for the biggest deduction in the first year, going to use the vehicle more than 50%, we strongly recommend buying the vehicle, assuming the other financial aspects work out for you, like payments. If you're not going to use the vehicle more than 50% business use, or if you're not going to drive many miles, strongly consider leasing, assuming other financial parts work out for you, the transaction. New for tax year 2024, the first year bonus depreciation has decreased down to 60% for the cars that you buy. This is not a concern for this example, $40,000 car. However, there's a thing called Section 280F auto depreciation limits that reduce the amount of depreciation. So the limit was 20,400 in 2023, and it dropped down to 20,200. We go through, here's an example of a depreciation schedule, a 40,000 car purchased and getting 20,200 for a deduction. For an asset placed in service in 2024, the first year deduction for the same scenario would be 20,400, leaving a remaining depreciation amount of 19,600 for next year, 2025. So in the middle of the page here, we're doing rough estimates of lease versus buy and total cash. So what we're looking here, the buying tax deduction for purchase, you got 20,000 annual, and then the total, and then the leasing, the amount of cash out of pocket. It ends up in this example showing that the lease has less deduction over time. So there's, like I mentioned, the calculators that are available. You should take your mileage on your car every year at the beginning of the year so you can track your expenses. There is a place where you can put it in QuickBooks or just put it on paper. At the end of the year, you look at your odometer again and compare it to figure out your total miles driven, and then get your business miles to come up with the business expenses for that year. People ask, how do I get the business use percentage? Well, one method is to take a 3-week time period and keep a log of every mile you drove during that time and determine whether it's business or personal. That way you're developing a business use ratio that you could show IRS auditors if necessary. And then stop the auto log and just take the mileage at the beginning and the ending of the year. When you write off a car for business and you're using the standard mileage method, you do not end up claiming depreciation. However, the standard mileage method has a factor of uh, what the depreciation actually was. So if we have 67 cents a mile for the expense in 2023, the law says that 28% of that number of mile or the cost that you wrote off is depreciation for the future when you sell the car. So if you bought the car for 20,000 and you claim depreciation based on this method, then if you sold it for 15,000, then you'd end up having a capital gain of 2,000. Okay, contract labor, line 11. So contract labor, the middle of the Schedule C. Independent contractors. This includes payments to persons you do not treat as employees for services performed during your performed for your trade or business. Do not include contract labor that you deducted elsewhere. Do not include salaries and wages you paid to employees. For individuals that you had hired as independent contractors, you need to file an IRS Form 1099 NEC to report any contact labor over $600 or more during the year. And virtually every small business that comes into my office says, we decided we're not going to have payroll. We're just going to have everyone be independent contractors. Well, sounds good. And then they say, we'll issue 1099s. Okay, sounds like you're following the rules. But the IRS or the Employment Development Department might come in and say, hey, these people do not really have their own business. They only work for you. And they're not in business, and you're just trying to go around payroll tax. So we're going to assess the business owners, all the employers' payroll tax, then all the employees' payroll tax, and then penalties for not taking out payroll. And what seemed like a good decision in the beginning for contract labor, independent contractors, is a horrible decision later if the workers are reclassified. Plus, if you have people on payroll, which is what I'm recommending, is do payroll, not independent contractors. You also can get workers' compensation insurance in the event that your workers are hurt on the job. The workers' compensation insurance takes care of any medical payments, and you're not personally liable on that because you have insurance. So treat independent contractors with a grain of salt. And in an audit, the EDD or IRS looks at whether the person were they really in business or not? Did they have other customers? They have business cards. They have business license. Did they use their own tools and equipment? Did they use yours? And they look at all the factors, and oftentimes the people don't qualify as independent contractors, and then the employer's got this huge payroll liability that they had never planned on. Okay, depreciation expense. And then the fast write-off depreciation called Section 179. Depreciation is the annual deduction allowed to recover the cost or other basis of business or investment property having a useful life substantially beyond the tax year. If you buy equipment that will last longer than a year, then it will likely be depreciated. But if your business owns property such as buildings, equipment, vehicles, you cannot deduct the full cost of your purchase price for that year because it's going to last more than a year. you prepare a separate statement on your tax return called a depreciation schedule and only claim a portion of the cost you paid, but over several years. You can also elect under this code section 179 to expense all or a part of the business asset that you bought during the year. And in that case, if you're claiming the 179, you on the depreciation schedule, you deduct the full expense of what you paid. And for 2024, the maximum amount you can write off in the first year is 1.2 million. However, this rule does not apply to real estate. Talk to a tax professional if you're claiming depreciation, as it can get complicated. Now, this is an example of a depreciation schedule. So we have, for example, all these costs. We have a tractor, a truck and tractor for diesel, and it costs 20,700, and we depreciated it last year, and now we're getting out of that 20,000, we're claiming 7,800 this year because it's written off over 5 years. Then we total the depreciation schedule for all the items we claimed as depreciation, and then we go back to the Schedule C and list on line 13 the total that we came up with for depreciation. Line 14, Schedule C, employee benefit plans. These are other than expenses you wrote off on line 19 for pensions. Deduct the contributions to employee benefit programs that are not an incidental part of a pension or profit sharing plan included on line 19. Examples are accident health insurance plans, group term life insurance, dependent care assistance programs. You cannot deduct the contributions you made on behalf of yourself as a self-employed person on the tax return. So employee benefit programs we just covered. Now we go on to line employee benefit programs. Okay, so I'm looking at trying to get my place here. Okay. And 14. Next, we'll cover rent or lease payments. So on the Schedule C, line 20, we're looking at rent or lease payments. So you get two choices: vehicles, rent, and then other property. So line 20A is vehicles, machinery, and equipment rental. Keep the lease payments in the auto expense worksheet rather than here. And the rent paid for machinery is self-explanatory, it's rental equipment. Rent on other business property, we keep it separate from machines. This is most often just a rental of office or warehouse costs. Moving down the lines, repairs and maintenance. So keep the auto expense. We had a special worksheet for that listed on that schedule, not here. And this would be repairs and maintenance for all other types of equipment or building repairs. An example would be a copy machine repair or something like that. Then we get into the expense item for supplies. That's self-explanatory. These are things that you use around the business that are not included in inventory, assuming you have a product business. Supplies are ancillary to you use in your business, for example, copy paper, pens, paper clips, and their supplies are considered they're not going to have value after 1 year. Then we go to line 23, which is tax and license. Tax and license, okay. This is for general tax and license a business has to pay. It does not include payroll taxes, which are included as part of wages on line 26 below. Do not include taxes paid when you were buying some other product or service like sales tax. Okay, so where are we here? We've gone through tax and license. Now it looks like we're at travel and meals. And that's line 24A. A travel expense is the ordinary and necessary expense of traveling away from home for business, for your job or profession. You can deduct expenses that are, you cannot deduct expenses that are lavish or extravagant or that are for personal use. So you're traveling away from home on business for a period substantially longer than a normal day's work, and you need to get sleep or rest at that faraway location because you can't get back home, and then you have a travel expense. Deductible travel expense while away from home include, but are not limited to, the cost of flight by airplane, train, transportation by car, tickets for transportation, taxi fares, tips, shipping baggage, using your car while traveling, lodging for travel expense, laundry. I know some people, when they travel, they bring all their dirty laundry so they can write it off. Uh, Business telephone calls and any tips that you pay in the business travel. And it used to be travel and entertainment. You notice there is no word that says entertainment now because entertainment is no longer deductible for tax purposes. Then we move on to line 24B, travel meals. Qualified meals expense are deductible subject to a 50% deduction limit. The meals expense is based on the actual cost of the meals, and you should keep receipts for the event and who was at the event to write off your meals. So what it says is you can only get a deduction for half of what you paid. So if you had 2,500 of business meals during the year, entertaining sales prospects, no, I shouldn't say entertaining and doing business meals, then only half of it would be deductible. Business-related entertainment expense deductions or entertainment facilities are not deductible now. We've been talking about actual cost of the meals and travel. There's another way to do this computation. It's called per diem rates. They got some Latin in there, per diem. Reminds me of the other phrase, carpe diem, take charge of the day. But these per diem rates are ballpark numbers you can use to write off because the U.S. General Service Administration established rates that federal agencies can use to reimburse their employees for lodging and meals and incidental expenses while on official government travel within the continental U.S. You can find these per diem rates at www.gsa.gov travel. And so what we're talking about here is they give you standard rates for meals and standard rates for hotels. And oftentimes it's based on the location of the part of the country that you're in. But this is a general, the per diem, this has to do with meals per diem. Breakfast, $7, lunch, 11, dinner, 23. And so what they're saying here is even without receipts, you can prove you went someplace, travel, and you had breakfast, lunch, and dinner. And if you don't have receipts, you can write off these standard per diem amounts. The next line item is utility expenses. This is self-explanatory. It refers to the cost incurred by a business or individual for essential services that are necessary for the operation of the business. Electricity, gas, water, trash, heating, internet, telephone. In business accounting, utility expenses are recorded as part of the operating expenses on the income statement. For individuals, utilities are part of household living expenses and not deductible. Wages, payroll. We recommend when you have payroll to get a payroll service to do your quarterly payroll reports. It's quite technical. Business payroll expenses refer to the total amount business spends on compensating its employees, including wages and salaries, direct payments made to employees for the work they perform. Employee benefits can include health insurance, retirement, and time paid off. Payroll taxes that a business is required, it's easy for you to say, that the business is required to pay on behalf of its employees, such as Social Security, Medicare, unemployment, and then it includes bonus and commissions, additional compensation. So we were on wages, going down the expense group here. And now we have other expenses, line 27A. And that 20 other expenses comes from the page 2 of the Schedule C, and it allows you to freeform whatever you want to call the expense. It's on the lower part of the page 2 of the Schedule C. So other expenses, this is a list from page 2, the Schedule C, line 48. It provides ample room to describe the business names, expense names that are not included in the pre-printed government form. The total of the other expense section is then brought forward to page 1 of the Schedule C and cross-reference to line 27A. So you just list the other types of expenses that weren't listed in the pre-printed forms. One thing I do in this area on the other expenses is I allocate expenses down to business use, and I tell the IRS what I did. So it says here, cell phone and internet at 80% business use. So it tells the IRS that I'm aware that everything you spend is not a business deduction, and I feel then the IRS knows you're aware that you're allocating expenses between business and personal expenses and only deducting the business part. So we total out this page 2 and bring it forward to page 1 of the Schedule C on line 27A. Are we having fun yet? I think so. Then at the bottom of the Schedule C, we're going to have our total expenses. Take the total income less total expenses, and we get a tentative profit. Tentative profit. And that is because we might want to deduct some home office costs. You have to do that first. This keeps the home office expense computation separate from the regular business expenses. So on the home office, we're there's two ways to deduct the home office. There's a simplified method that does not change the criteria who may claim a home deduction. It merely simplifies the calculation for record keeping. This is still meaning that if you're claiming a home office, you have to have exclusive use of a certain area of your home that you use only for business. If you have like a kitchen table and you eat there and you do business on the table, you cannot write that off because it's not exclusive use of the premises. So there is no home office deduction in that category or that area. The highlights of the simplified plan is there's a standard deduction for home office of $5 per square foot of your home that you use exclusively for business. And there's a maximum of 300 square feet that you can use. So under the simplified method, the maximum write-off you can get for your home is $1,500. Allowable home-related itemized deductions are claimed in full on Schedule A. For example, real estate taxes, interest, no home depreciation is calculated using the simplified home office method. Then, okay, so what we did here, let's see, yeah, home office. Boy, we're getting all over here. So continuing on the home office, there's a chart that shows if the home office expenses cause the business to go into a loss, then no home office expenses are deducted for the year. If you take the standard method for home office and you have a loss, that loss disappears forever. If you use the regular method, which is the method that you take, we'll cover it in a minute, you write out all your home office costs, and then we break it down to the business use percentage. And if you have a loss on the business from the regular method of home office, then you can, in fact, carry the loss next year and use the loss against income next year. So that's an advantage of the more detailed regular method. So let's figure out how to calculate home office expenses. In order to do that, you need to go to IRS Form 8829, expenses for business use of your home. So in this form, it says, what's your business use? It says 300 square feet. Now, total area of your home, we'll say 2,000. What percentage of your home are you using for business? It says 15%. The other lines are only used for daycare, so we're going to skip those. Daycare facilities. So we have a business use percentage for the home office. Now, let's get into the actual costs. We have one column that says direct expenses, and that would be for expenses that solely apply to the home office. So if you have a room in your home that's your home office and you had it painted, then that would be a direct expense on this schedule. The column that says indirect expense means that this expense includes elements of business and elements of personal. So we need to break it down. It's hammer time. And break down the expenses to business use components. So here you follow the lines: real estate taxes, interest, repairs, utilities, and then the business use percentage, if we recall, was 15%. And so that's what we write off is the only the business use. And then we, for example, we ended up deciding to use the simplified method because the actual came out to 1,324. And then we went to the actual cost and it turned out we got, I mean, the simplified method gave us a write-off of $1,500. So you claim the higher of the two. And then after you write off the home office, then we get to ta-da, the net profit and loss from the business. Wow, we finally got to the net profit or loss on the business. Now, when you get to the net income on line 31, you end up going two directions on taking that number. One is you take that net income over to your income and apply regular income tax to it. The other is you go to Schedule SE for self-employment tax and you apply the self-employment tax or Social Security. And so a sole proprietorship has two taxes on its net income. The income tax plus self-employment tax, which is equivalent to a W-2 employee having Social Security withheld. The difference is on a W-2 employee, the Social Security is only half, the employee only pays half of the Social Security on wages. The employer pays the other half because we are going up to 15.3% of the income. And on the W-2, that Social Security is calculated on the gross income. And on self-employed individuals, it's calculated on the net income after expenses. So we're looking for another 15.3% of additional tax on a small business. So in our example here, we have a net income of 188,000. Okay, fine. And then there's two components, FICA and Medicare. We'll just combine them. And then 15.3% of that income is an additional tax of 24,914. So people whine, moan, and complain and say, well, dang, why do I have to pay that much in self-employment tax and it's gone? That's not entirely true. The way that it works is this payment of the 24,914 goes into your Social Security account and it'll later come back to you as Social Security earnings. And don't worry if Social Security goes broke, it's already broke. They'll just print the money and you'll get paid anyway. Now, so the other part of the self-employment tax, we have we're paying 24,900 on self-employment tax. We get to deduct as a income tax deduction half of the self-employment tax. So yes, there's a tax and yes, there's a deduction that comes from the Schedule SE for self-employment tax. Are we having fun yet? I think so. Now, here's the self-employment tax schedule all in one eyeful. So what are we doing here? We have the net income, and then we come down and find out how much we need to pay in a couple different methods of computation, Medicare and FICA separate, 24,000 of self-employment tax and 12,000 additional deductions. At risk limitation. Well, this little puppy is a question on the bottom of the 1040 that it's primarily designed for rich people that just put money in a business and don't do anything. So you can see here, if you have a loss, then you want to know if you have amount at risk, your own money or skin in the game, or none of the money, and then they're going to limit your losses. And then you have to fill out that at-risk limitation form 6198. I don't see it that often. It's for people looking for tax shelters. They just put money in a business. They don't do any work. And then this comes into effect when the entity has a loss. So what did we cover today? What we covered, what is a Schedule C that's attached to the IRS Form 1040? Who must file and use this form? What kind of stuff do you put on the Schedule C? What is taxable income and what is not? What you can deduct to make your tax bill as small as possible. It's free enterprise system in action with you being the boss. We covered different types of expenses, including vehicle costs, depreciation, business operating expenses, home office costs, allocation of business and personal expenses. Oh, did we have fun? Yes, sirree. And how to keep out of trouble with the Internal Revenue Service and the Franchise Tax Board. So that covers what we're talking about today on Schedule C. I want to thank you for your time and attention, and we will conclude at this point.